Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, Michael Becker.
Hey, Paul.
And also James Eng with Old Capital joining us into the podcast today. So in the podcast, I want you to meet your new best friend. Your new best friend is the guy who's going to make you or break you in apartment property management. And it is such an important element of ownership is having a good relationship with your property management company. And in today's podcast, we're going to bring in Michael Becker's property management company that he has done business with for a number of years. And I can't think of a better property management company than the one that you're going to be introduced to right now. So Craig Lashley and Todd Parks are with SIMC, and they are third-party property managers. Again, they are with a third party. They don't work for Mike. They are an independent company, but they are hired by Mike. And having a property management company can make you or break you on the ownership. And so I'm going to kick it over to James here. But first, Craig, thanks for coming in.
Hey,
Todd?
Thank you for having us.
Hey, Paul, thanks for having us today.
No problem. Thanks for coming in. I'm going to kick it over to James, and then I'll spend some time with Michael.
Greg, why don't you start? Just give us a little bit of your background and sort of how you got into this business.
Sure. So I got into this business about 12 years ago. I came out of the equity markets. I had my Series 763, decided that was a business I didn't want to go into a long-term, like the tangible assets. Kind of grew up in a blue-collar type family. So I liked having my hands on assets and being able to see them, being able to see the transformation and the change. So I joined the group and essentially started to grow the business from there about 12 years ago. I started in the asset management side. I saw that on the asset management side, as we worked with property managers, there was a lot of lack of sophistication. There was a lot of kind of, I don't care what actually happens, right? They would send me a contract to sign off on, and I'd ask a question or two, and then they wouldn't really know the answer. They'd have to go back to 3 or 4 other people. It'd take a week. It's like, hey, this is literally just a copy or lease at a property. Like, you should know what's going on, right? So I say, hey, we can be better here. So about 4 years ago or so, I started to transition within the group more to the property management side. I kind of bring that ownership approach to the group and kind of solve some of those equations that we had problems with across the board. So that's how I got into the business and took over the active management role of our group about 3 years ago from my predecessor and mentor, George Martin, who had run the business for about 27 years. So we've been around for about 30 years and have a great relationship with a lot of contractors and owners throughout the Metroplex.
So maybe tell a little bit about SMC. So you've been in charge about 4 years, but tell us a little bit about the company, kind of the origins of it.
Sure. So we started back in the late 80s in 87. So we're going on our 30th year now. For a long time, we kind of just owner managed for our own account. So all the way up until about 2 years ago. And when I took over the company, we decided to, you know what, we can expand this brand and bring, our way of doing things out to the open market and kind of expand. That's when I met Michael, and our relationship kind of started to grow over time, but kind of bring this stuff. I mean, at the end of the day, the people that are inside of our organization, myself, we want to help people, right? As Paul mentioned before, properties can be made or broken based off of the property management group. And a lot of times that's undervalued. So we're here to help people at our core. And ultimately, that's why we brought our third party management brand out about 2 years ago.
How many units do you guys manage right now?
Yeah, right now across our platform, we manage a little over 7,500 units. So we've grown quite a bit in the last couple of years, which has been great. I think it's been a real credit of what we've done, what Michael, you've been able to do, and ultimately kind of being an agent of change within the business as well.
So all management companies aren't the same. They focus on different things. What does your general portfolio look like right now? What do you guys actively, what do you manage, and what do you guys look when you're out there, bidding on business?
Yeah, it's a good question. I mean, the fairway for our group, we've been really established as a 200 plus unit management company throughout the Metroplex. That's probably where we service the best. Ultimately, we will do some stuff that's a little bit smaller, but it has to have some geographical presence to another deal that we have. So, for example, we do manage a couple 100-unit deals, 150-unit deals, but they have good presence to other assets in that market that we're able to service.
Gotcha. So when I think of a management company, I think of kind of like three functions primarily that you guys, management company serves for an apartment ownership group like ours, or most of the people that listen to this podcast. You have kind of your accounting, your back office, you do your books, you do your payables, receivables, et cetera. You have your HR. So all the employees on the property are they're employees of the management company and kind of pass through that expense. And then finally kind of like construction component of the business, both on, just turning over units on a regular, clean it out, do a quick paint job, up to big capital projects like hardy and paint. So maybe kind of talk a little bit about those three aspects and kind of how you guys handle that, or there's something else that is important that I didn't mention, maybe another aspect that I missed, but those are kind of what I think of when I'm thinking of it.
Sure. So just breaking down those three aspects, and there are a couple other small ones that I'll touch on as well, but ultimately it breaks down to first HR. The HR component's very important. Everybody, if you read any property management company's marketing material, they're going to talk about their people first, right? And I'm not saying that that's not important, and it is our focus, but it's not necessarily the only focus inside of the group. So the HR component, as we have grown, we look for people that maybe are outside of the industry, right? Don't come in with the same prerequisites as maybe, hey, I was a leasing manager, now I'm a manager, now I'm a regional, or follow that path. And there are some people that are very good, right? But we as a company want to kind of break outside of that mold. So Todd, who's joined me today, he comes from outside of the industry as well. But we do have a good mix of a lot of people that are inside too. So we grab from a couple different institutional groups, but ultimately we consider ourselves a very entrepreneurial type group.
So speaking of that, before we move on, how do you guys manage like staffing? So you have from your part-time leasing agent, maintenance, lead maintenance manager, et cetera. So how does that hierarchy within a management company, how does that lay out for if someone's never interacted or engaged in a management company? How does that kind of typically work?
Sure. It kind of breaks down into two components. One is the site level staff, which is usually kind of a self-contained group, right? So led by the manager is more or less the head of that group. So the manager will be in the office along with an assistant manager, probably sometimes some leasing component with a leasing manager and also a leasing consultant. It just depends on the mix and the size of the asset. Then on the outside team, there's a lead maintenance or a maintenance supervisor along with some make ready or assistant maintenance guys and a porter to keep the property clean and help trash out units. Then the next component up is going to be your corporate staff, right? So there's a clear delineation of when an owner is charged or should be charged by a management company for those two components. So as you mentioned earlier, the site level staff, although employed by SIMC or your property management company to help kind of alleviate some of the risk of the property owner, in addition to not having the property employees call you because they have a problem, we handle all of that as most management companies do. Those are all fully reimbursable at the property level. Now, you move into the corporate staff. That's where it starts to get a little bit different between different property management companies. And what we've done is we've built a company where the ratio is lower on regionals to properties. Typically, in a larger company, you're going to have more properties per regional manager, which is the one that oversees the manager and ultimately the property, kind of communicates with the owner as far as the execution of the vision and things like that. And then within that corporate team, you also typically have an HR component, obviously an admin component that's answering the phones and helping with the paperwork when you take over, alleviate an asset, right, from the city, the different municipalities, the utilities, that kind of stuff. And then a marketing component and an IT component. Sometimes you got to be careful with management companies. They'll charge back through those different components to the property. They'll spread them across your portfolio, right? And you just got to watch it in the contract, right? We try to have a very simple structure. We charge one fee, right?
Yeah. So maybe move over to accounting. So that's obviously a big component, paying bills, receiving revenue, doing financial statements. Maybe talk a little bit about what someone should expect if they interact with the management company from the accounting function.
Yeah, so an accounting function, again, kind of breaks down to two different componentries. There's the delivery of the financial statements on a monthly basis, and then there's the draws to the lender and kind of lender communications, right? And the first is pretty straightforward, and it should be fairly standard across the industry that you're going to have the accounting group provide financial statements that are prepared by the management company to the owner somewhere around the 15th of every month. That's pretty standard.
Right.
And the packages change between different companies and they change between different owners, right? As an owner, don't be afraid to maybe customize the package just slightly, but usually follow the management company's guidance. The management company then typically will submit those financials to the lender. And then there's the lender draws, right? Which are kind of the bane of a lot of people's existence.
Pain in the butt, no question.
No question about it. So you have your replacement reserve draws that are done typically in an agency loan on a quarterly basis. And then you have your immediate repairs draws or sometimes your rehab money that's drawn on a monthly basis. And the amount of work that goes in at the accounting level to get that money back from the lender is pretty substantial. And every group has their own way of handling that. Some charge extra, some don't. Some do it. Some owners do it instead of the management company. We tend to handle it all.
Yeah, perfect. And then finally, construction projects, et cetera. So obviously, you have the normal turnover just to kind of operate a property. Then you do some capital projects. So like for our properties, you do our capital projects, kind of help spearhead and oversee that. So maybe talk a little bit about that part specifically.
Yep. And we have our own construction management arm. There's a construction manager inside of our house that has about 15 years of experience in the industry. Like I said before, with the 30 years of experience in the submarket, we have great vendor relationships.
Now, Mike, why do you like SIMC? Why do you have a great relationship with Craig?
Something that kind of just grew over time, I think, really. We kind of met and talked about it, and they weren't at the time doing third-party management, Paul, when we first started talking about it, and then came out, and I guess I was kind of the guinea pig maybe a little bit on the first property, and we did well. And it's just a trust level that's built over many properties, multiple years. And it's just communication. That's one of the, I think they do well, is they communicate. And then a lot of people can drive revenue, and revenue is always extremely important, obviously. But I feel like every dollar that they spend is carefully thought out. So it's not just like every time we have a problem, what I've experienced with some other people and what I've observed with other people is every time there's a problem, you just throw money at it, whether money is the right solution or not. Where with SIMC, I haven't had that feeling. Like every dollar they spend, it's like their own, as close as that could be to being their own dollars.
Is there an example out there, maybe on a property, on this first couple properties that they took over for you that really made a big impact on the bottom line?
Well, we did the first deal we did was in Grapevine. So we bought a property at the time. It was called Regional Place, which is like the worst apartment name I've ever heard in my entire life. So we bought the Regional Place Apartments and changed the name to Encore Mustang. And I guess it's got to be the worst property in Grapevine, Craig, or was?
It was.
Yeah, definitely one of the worst properties in Grapevine. So, for example, the previous ownership group was doing on their turnovers, putting in used carpet, which is the most disgusting thing I've ever heard, I think, in an apartment complex. So, used carpet. And what we've historically done up to that point was just like every unit, go in, turn it, no matter what. Kind of maybe talk about that on your turnover costs and kind of how you stretch the dollar a little bit there as well, Craig.
Yeah, so like Michael said, I think we take great pride in obviously, and I talked a little bit earlier about my background just personally, right? Grew up blue collar, understand how to hang drywall myself, understand how to lay carpet, that kind of stuff. So very few things get by us at the corporate level of getting kind of pushed over, right? So at Grapevine in particular, when we started with Michael, I think he was just accustomed to everything being contracted out. And we kind of pushed a lot back to their on-site staff, right? A lot of times you'll see contract painting, for example. Sometimes the maintenance guys will actually paint themselves. Sometimes you contract out, sometimes flooring, same kind of thing. So we brought that whole mindset to the Grapevine property as well as some of the other properties within Michael and our other clients' portfolios across the board. And ultimately, I think at the end of the day, Michael, if I remember right, on the Grapevine property in particular, you were yelling at me to spend to some degree more money faster because the lender was bugging us to get all the draw money out.
That's right. Yeah. We're going past our time because we weren't spending as much money, so we came in under budget, and it caused another issue with the lender that we had to go figure out, which is a good problem to have, but it was still a problem.
Yeah.
Is there any other one or two things that you see consistently on the takeovers of new properties that our investors should be aware of, maybe, and should be on the lookout for in terms of what other management companies are doing that maybe isn't ideal or effective?
Sure. I mean, everybody kind of, as soon as they go through the sales process, right, they kind of change their mentality. And to some degree, everyone is the same that way. It's like when you're done with something, you're kind of done with it, right? So what you have to watch out for as an owner or buyer is having a prolonged escrow period, right? Because no matter how good the property management company is, and we see a lot of bad ones, obviously, through this process, the gas pedal gets let off, right? And it's just the magnitude of how much that gas pedal is let off.
That's a great point, because people go under contract, management companies who may not be getting the new job, take their foot off the gas. Employees may be jumping out of the buildings. You see all kinds of different things going on with the properties, and all of a sudden your occupancy starts to fall off. And all of a sudden then I have to take a look at the operating statement for last month, because we're about to close the loan for this month, and you're down 20% in occupancy. So before you take over a property, make sure the management company hasn't put it into the ground. So make sure you stress to the seller, do not take your eye off the ball. So I want to hear some secrets, Craig. I mean, we couldn't have a better guest than Craig or Todd. But tell us a little bit about this LRO. What the heck does that mean? And then Todd, I'm going to bend your ear a little bit about marketing. About how do you market to? How do you get new tenants in? Are the tenants all millennials, and how do you market to the older folks? And so I'm gonna kick it back over to Craig.
Sure. So Paul's trying to tap into the old secret sauce here.
Secret
but
sauce.
Hey, as far as it goes, Todd will talk a little bit about the marketing, but on the revenue side of the equation, so a lot of property managers will stress, obviously, great expense controls, right? And to some degree, it's a leap of faith. Everyone will say that they manage like their own, but nothing is more powerful than hearing, Michael or other clients talk about how we actually care, and we really appreciate that, because a lot of effort does go into that. It's easy to take your eye off the ball on the expense side, and it's easy just to hire a plumber instead of make your maintenance guy do it, or press back to your supervisors to press on those things. But on the revenue side, it's where it gets a little bit more sophisticated, right? And this is where my ownership background on the asset management side, as well as managing for some institutional groups as well, bringing that mindset into the BC space has really helped out. But what Paul was mentioning with LRO is it's a revenue management software, and there's a number of different great companies out there for revenue management. LRO just happens to be the one that we utilize the most. And it's best explained like this. Ultimately, everyone on this has hopefully bought or looked at buying airfare online or buying a hotel room for the night online. If you go on there and you look 2-3 times, it recognizes your IP address, right? And then the prices start to go up. Or if there's a number of inquiries on that same flight during the course of that day, the price will go up over the course of the day. Same kind of concept here, a little bit more sophisticated though when it comes to apartment leasing. So essentially, it's an algorithm that's utilized on the apartment rate side, takes into account all of our competitors, where they stand in occupancy specifically on that unit type, where they are in proximity to us, what kind of amenities they have versus us, what kind of traffic we're getting. So for example, if we have a specific unit, say it's a 300 unit deal, right? We have a specific unit that just hasn't leased, right? And it's been shown 3 or 4 or 5 times. First, we got to assess whether or not there was something wrong with that unit, right? But if there hadn't been, it just means that there's something that the consumer is telling us that maybe they're only they'll pay $10 less for that same unit. So we'll start to play with the rates on each underlying unit. And ultimately, there's no way for you as an individual owner to do that, right? You'd spend your entire day trying to figure this all out. That's where it's interesting, right? Because most owners in the BC space, they wait till their property to get highly occupied as a whole, right? They'll wait till it gets 98, 99, 100% occupied. Well, they might have been 100% occupied on all their one bedrooms, maybe their A1s that whole time, and they didn't push revenue until the entire property got up there. Whereas we're adjusting pricing every day. We're also adjusting pricing based off a lease term as well. So lease terms that are longer receive a better rate. Sometimes that's not always true, because we also are doing lease expiration management. We don't want a lot of leases expiring when there's not a lot of demand.
Yeah, it's amazing how that maximum revenue equation works, because sometimes you'll find these leases, when you look at them, it won't be $750 a month. It'll be $783.14. I mean,
yeah.
It goes out there and tries to figure out exactly what's going on.
Yeah.
No, and that was yesterday, and then today it's a different price.
Yeah. What have you done for me lately? What's the most amount of money I can charge for this unit? Now, Todd, tell me very, very quietly. What do you guys do for marketing? How does this work, and how do you get the best tenants on your properties?
Yeah, so it's a really good question. It's something we talk a lot about every day. Something that it's constantly changing. So a big thing in marketing is the data. So what data are we getting, finding? We look at do market search, research, surveys, look and see, what is the area like? What is the ideal? Obviously, anybody that qualifies is a great leaser, but who is that in each area? So depending upon the demographics, what we're going after, we'll do targeted marketing, for that typically. So for a long time in the industry, you've had your ILS systems. So your apartments.com, things like that, where people go. But now things are really shifting. People are really wanting to do their own research. And then, we want ads to be able to be seen. So we put things on Facebook. Where people live the most nowadays on their phones is on social media. So there may be people that are moving in 90 days. They're not looking yet. But if we have Facebook ads out, Instagram ads, just different types of social media platforms, we'll put ads out targeting a certain demographic or age or interest based on amenities and really, try to bring it in. So that's a little bit something that we're doing new that's kind of different from the industry. It's really focusing in on where are people spending all their time today, and that's in social media.
Yeah, last year, 2 years ago, 10 years ago, was all about the amount of flags you could put on a property, the size of the sign you had in front, now leasing type of stuff. So you were waiting for somebody to drive by your property, which would be down at the end of a cul-de-sac and nobody would see it. But today you're pushing out to the consumer what's available out there. And so do you guys have budgets that you guys work through for every client? And how does that work?
Yeah, and so Craig can speak to this as well. But what we like to do is obviously you want to still stay committed to your ILS system, but we like to pick based on where the market is. Some of the ILS systems work better in certain targeted areas than another. So versus putting it on every single one of them, we'll pick a couple of specific ones to target. And then we'll look at other ways like the social media things. We're noticing that the people that are renting apartments more and more are leasing online or maybe never even coming to the site because they're moving from the West Coast. So they've got 6 weeks to move. And the last thing they can do is fly out here to find a place. So we're really trying to come up with new and innovative ways to reach them through that. So putting our budget together around, that.
It really is a phenomenon with these younger folks today is that they don't want to be seen, touched, or felt. They want to sneak in, look for a unit, and get the hell out of there as quickly as possible. They want no or limited interaction with people these days.
Yeah, absolutely. So one big thing we've seen an uptick in just the past few months is just Facebook Messenger. So people see our properties online, and now instead of calling the property, emailing, they're just sending a message, like a live chat message directly through Facebook, asking questions about the property, the rents, wanting to know about their dogs, things like that. So we're staying, connected to them 24 hours, 7 days a week through our phones, and everyone's, plugged in through Facebook to be able to answer these questions as they come in.
Yeah, everyone has a dog, right? I mean, Jesus, that's changed over the last few years. Like every renter has a dog nowadays. So that's one of the things we try to do at virtually every property we own is have a pet park or dog park. You've been in the business over a decade now, Craig. So what have you seen as far as amenity sets and how things have changed, say 2017 versus say 2007? What differences do you see in the amenity set and what's really driving the renter's preference and converting that into leases?
Sure, yeah. And there's been a lot of kind of transition in that amenity base as well. Obviously, as the market has gotten better, there's been more capital dollars spent on amenities and trying to figure this out and trying to bridge the gap between B, C products, kind of getting to more the B plus range, right? So what we've seen most recently is the big amenity push is the package rooms, right? So as Amazon has become more and more popular, I'm sure a lot of you, as I do, walk home to one or five
boxes every day, right? Yeah.
And you got to remember what you bought. You're like, I don't even remember what I
don't
ordered.
think I bought any of it, to be honest with you, Todd. I might have paid for it all, but I didn't purchase any of it.
That's right. So obviously that is kind of a two-prong issue. One is that the renter may be coming home at 6 or 6:30 or 7 from their job, or maybe they work second shift or third shift, and when they want to get their package, the office isn't available for them, right?
Right, because UPS or FedEx will not drop the package at the front door of an apartment complex that they would at your home. So that's the issue. So they deliver them to the office.
That's right. That's right. And the second issue is that now the office staff is just playing the middleman, right? So it's taking them away from working on new marketing concepts or dealing with the paperwork and making sure that the vendors are in line and they're double checking the move outs and all that kind of stuff. So there's been a big push for those package rooms because they're a 24-hour service. The services can drop those packages in those lockers. The residents can walk in and get those packages. Plus, it's turned into an additional revenue item for the owners as well, right? So in some cases, the owners have decided where they put in these package rooms and spend the upfront capital cost that they'll bear the cost of the subscription service to that. And then there's some where it's like, no, I'm going to have my residents pay for this service. And it ultimately becomes a spread game, kind of like valet trash, right? Valet trash charges the owner maybe $12. You charge the resident 25.
25, yeah.
You make the spread of 13 on 200 units, and all of a sudden your cap value is $500,000 on that decision alone.
That's good. So we've all, obviously, the last 6-7 years has just been kind of banner years, especially the last like 5 or 4. You guys have been around a long time as a company. You've been through a cycle or 2 now. What are some of the takeaways? Everything's been easy right now. So everyone's rent's going up. The bad properties are even full. We can't make a bad loan seemingly right now. So we can even screw up and still make a good loan because the market's going to come bail you out. But that's not always going to be the case. What are some things you observed back through the last cycle? You guys own numerous properties that you self-managed through the last cycle. What are some of the characteristics of the properties that outperform the other ones, or maybe some of the observations and maybe some of the lessons you can impart upon some people as we're, who knows how long the cycle is going to go. I don't see any immediate threat in the DFW market at the moment, wholesale, but it's going to cycle down at some point. Any thoughts or comments about that?
Sure. Yeah, there's kind of the tangible lessons and then the intangible lessons, right? So from an intangible side, I'd say that obviously working over the last decade, we went through one of the worst real estate recessions of all time. Actually, a lot of people don't realize there was a greater loss of value in real estate assets, commercial real estate assets on a percentage basis than the country had ever seen before. So it was a very interesting time to work through an ownership platform and understand what that means, right? So during that period, I would say that, as an asset manager, I was overseeing our property management group and our on-site staffs and thinking we need to make some changes. But I wasn't necessarily as vocal as I probably should have been just because everything was so good, right? So I kind of took a back seat and I learned my lesson there, right? The things that I felt in my gut and what needed to be changed and would have helped us weather through a little bit better of the storm. Although no matter what, people were going to feel the pain of that recession. So there's kind of the intangible aspect of you being the owner, having a great relationship and more of a partnership type feel towards your property management group, and a lot of active discussions of challenging a couple of the decisions. I'm not saying go out to the properties and physically challenge the decisions, right? I'm saying if you got a once a week or once a month conference call with your property management group, you go out there and you say, hey, you know what? I think that we should challenge this decision a little bit more.
Let's kind of talk about that because that's important. Everyone thinks, well, I'm just going to fire my property management company. But there's a reverse to it. They could fire you. So my question really is that how do you guys want to be treated? And on top of that, is that what type of interaction do you think you should have or the ownership group should have with the property management company? Because I know there's a couple of borrowers that we have that, yes, they're the owner of the property, but they want to sit in the office every day. They want to put a table in there and go in there 2-3 times a week and just kind of oversee the deal. We don't like that.
Yeah, that's right. It's like a relinquishment of your ego to some degree, right? So a lot of owners, they come in, they buy a property. They want people to know that they're the owner, right? And what they don't realize, the people know they're the owner.
Yeah, I definitely don't want anyone to know that I own a property, right? That's the last thing you want to be on that property as the owner, that's for sure. But go ahead, I interrupted you.
That's exactly right, though, Michael. I mean, you as the owner don't want to be necessarily known at the property, especially by the residents, obviously. Now, the property management group, the staff, they should respect you as the owner. But as you show up more and more, you lose that level of respect and that dignification. So what you have to do as an owner, you have to realize, okay, I've taken the leap, right? I've hired this professional group that all they do is this every day, day in, day out, right? Maybe they'll react a little bit slower than I would if I was there all the time, right? Because no one can be as good as one owner on one asset all the time. But that owner also isn't necessarily a pro. even LRO, the other stuff that we do, the pricing metrics that we can get as a whole over 7,500 units versus maybe a 200 unit individual owner, I can guarantee you that will create more value than you sitting on. And I think what a lot of owners forget is that when they go out there, they want everything right then, right? And there is a little bit of a relinquishment of, hey, we can handle that tomorrow. We need to focus on what's important today. And they need to trust us to understand that with 30 years of experience and the amount of success that we've had and other management companies have had.
Yeah, maybe Paul or James, you could talk about this. You guys have been longtime bankers. Maybe talk a little on your observation of the difference between asset management and property management and some of the delineation of roles between the two, because they're somewhat similar, but definitely not the same. That's for sure.
Most asset managers, and back in my time at GE, they would have like 10, 15 properties, right? And so they're really, more checking the budget, making sure, on a monthly basis that you're hitting your numbers, and they weren't in the office, right? So they're trusting you and putting you in place for a reason. And so you're a huge part of the team. And I think good asset managers know when to step in compared to being there 24/7 on a property. So
Yeah. So let's kind of start at the top. I mean, the equity really dictates what's going on. The managing member is reported to. The equity wants that person to be the tip of the spear. That managing member really is the asset manager. And you're supposed to have an interaction with the property manager. You're supposed to oversee it. But as an asset manager, your job is not to manage the property. That's why you hire guys like Craig and Todd, for them to oversee the property, do your accounting, do your K1s, oversee the human resources, make sure the interaction with the city goes great, execute on all the rehab on the property, get that stuff done. Your job is not to manage the property. Your job is to manage the partnership, for one, but two, go out there and find another property to buy and raise more money. So now that comes down to, at what period of time of size, Craig, do you think, we talked about it a little bit before, but just in general, I mean, you guys look at 200 units and above. Where do you think, in the big picture of things, I mean, that's your group. Where do you think property managers really make sense to come in? Is it 75 to 100 doors and above? I mean, where do you see it to be?
Yeah, no, great question, Paul. And there's a lot of great groups that have kind of formulated their business around maybe the smaller properties, right? We've obviously taken more of the institutional type route, trying to bring that kind of workership mentality and blue collar mentality towards the institutional crowd. But I think, just to answer your question briefly, it's somewhere around 60 units or so, where you can actually have, once you start to employ people at the site level, is really when you should probably start thinking, hey, I need a property management company to mitigate your own risk too.
Yeah, property management is such a critical piece of your success. If you don't have a property management company because you don't have enough units to afford a property management company, you are the property manager. You may have a full-time job doing something else, but now you may have to manage the property outright, which I don't advocate. I don't want you to do that. And that property management is a team player with you, is that if someone gets sick in your team, they can definitely shift around an assistant manager to come on over to your property. They can shift around a maintenance person. So you're never left all by yourself, that you can't go on vacation and you can't separate yourself from the building. And that's such an important point, is that why own all this stuff? If you're trying to save a nickel or two, it'll turn out, just like Craig says, you're losing money. I mean, you're definitely losing money, because Craig's group with Todd has economies of scale of buying power and purchasing power. And it's just not the small stuff. I'm talking about countertops and flooring and paint and labor and materials that you couldn't even come close to putting together the savings that they're going to acquire with having 7,500 doors available. Anything more to add to that?
Yeah, no, you're right, Paul. I mean, at the end of the day, we import granite by the container load, right, for our clients. You'd never be able to do that on your own, probably, unless you had a lot of units to take care of all at once.
All right. How do you get fired?
How does the client get fired?
How does the client get fired?
That's a good question. That's a delicate
tried,
one.
yeah. So one thing we do before, like in the process of looking at, bringing on a new property, we're getting interviewed by the owner. We're interviewing them too, in essence, right? Because we want to work, it's essentially a marriage. We want good transparency. We want to talk, we want to have an open dialogue. And I think, so that if we see that at the beginning is going to be an issue, we try to address that. One of the biggest things, kind of going back to being on site all the time, is it creates a huge bottleneck. So if, the owner's there multiple hours every day or every other day, they're spending time with the property manager, where now the manager's not able to do what they need to do. So now they're calling, their supervisor saying, hey, I can't get this done because the owner spent the afternoon out here again today. And now we're, a day late getting financials in, things like that. So
yeah, at the end of the day, it's like, who's ever had a boss where the people just go around them all the time, right? And when you're the person in the middle getting that treatment, you don't want to work for them anymore, right? So we are the same kind of thing in our position, right? When the owner is just going around us constantly at the corporate level to the site staff, right? And there's a mixed message being sent. Maybe we want them to execute X and the owner wants them to execute Y just because they were there that day and they saw that specific issue. Maybe that's third on the list instead of first on the list. That's how you get fired as an owner with our group or with any group, right? Is you get in the middle and you start to cause some turmoil within the group, because sometimes it's a catalyst for change and it's good at the asset, but 99% of the time, it's really bad for business. It's bad for the asset. And at the end of the day, that's what we care about, right? We care about how that asset performs because that's our scorecard. Like James said, with the institutional groups at the asset management level. And when we look at it at the corporate level, our scorecard is reported every single month on how we do.
You know what to focus on and what's going to bring you business. Is there anything, just since you took over on the third-party management side, anything in the last couple of years that maybe you thought it should be done this way, and now after doing it a couple of years, maybe something that's changed or something that's changed on your end in terms of management? Anything out there that you guys can think of that?
Yeah, I think one thing that's great for Craig to talk about is how we hold everybody accountable inside the office from the top down. And how that's transitioned from other management companies and what you saw before to now.
Yeah. So what I was seeing a lot, James, at the asset management level was, I would try to get a hold of a regional manager. One time I tried to get a hold of a regional manager as an asset manager, and I called him. And it was midday, like 2 p.m. And he must have just looked briefly at his phone and thought it was a buddy. He texts me back, I'm in a movie. I'll call you back a little later, right? And I'm thinking, wow, this is not cool, man. So I texted him back a hot one, right? I was really upset. But and what Todd's alluding to is what I did right out of the gates is I made everybody in our entire group accountable, right? We use a punch in, punch out system that geocodes tags and ultimately geofences in our properties so that we know our managers are showing up. It gets down to the basics, right? I try to relate this to a retail store for our people, right? If an owner sees on the front of the store or the property, the office, that it's open from 8:30 to 5:30 and they show up at 2, they don't care that you took a late lunch, right? They want that office open. So part of it is just keeping people accountable, and then keeping people accountable at the corporate level is a whole nother challenge because, like Todd mentioned, in our industry, this is non-standard. Very few companies will do this. I've gotten a lot of pushback internally with this. But ultimately, everyone's seen the change and they're starting to buy in. They're starting to feel it. And I think, Michael, you can probably speak well to this because you've seen it in time as you've moved throughout management companies.
Yeah, I don't know if he quite said it, but he makes his regional levels clock in, clock out, so he knows where they're at. So I know that causes some friction for Craig along the way as well.
More good than bad, though.
More good than Friction is not all bad. So, but yeah, that's one thing I definitely have observed from other people, and then I've certainly experienced it in our properties and just running our own business. We have employees that if you don't measure it and you don't track it and someone's not accountable for it, it doesn't get done. So you need to have, someone individually be held accountable, and you need to track and follow. And if you don't, things get slipped through the cracks and these details, and maybe it's a little thing, but then you accumulate a bunch of little things and it becomes a big thing after a while. So that's certainly one thing that I definitely appreciate with the group SMC is that, there's accountability, there's follow through, the transparency. That's how we try to run our business here as well. So just making sure that you have those core basic things is good foundation for success, I think.
Let me ask another quiet question. What software do you guys use for property management, and why do you use it?
Yeah, so we have almost our whole platform on Yardi. And the reason why we use Yardi is a couple different reasons. And there's a lot of great software systems out there. But one, it's internet-based. So we give all of our clients read-only access to their properties so that they can see. Some people are they want the data and they want the data then. And we can't necessarily always provide it immediately for their gratification, right? Michael's sitting at home at 10 p.m. He's wondering how one of his properties' occupancies looks. He can go into Yardi and he can look at the trend. He can look at where it's at right now. He can see how many guest cards are in there, and he can drill all the way down to see the people and who are working on them and everything like that. So really love the online platform. Now, there's a couple different accounting programs. We try to keep everything consistent across our platform. It gives us the best product for our clients, and plus we get premium pricing that way. I've seen a lot of systems. I think we just saved you about $18K on your accounting system on this last deal a year. So in just one property. So we use that platform primarily for those reasons, and then it also integrates with our website. So ultimately, we have end-to-end for our consumer, right? They can go on our website, they can see the pictures of the asset, they can apply online, they can put their application, they can see the rent that's integrated through LRO as well for that specific unit, and then this basically portals through to our accounting system.
So maybe we kind of transition here, kind of last part of the podcast, and talk a little bit about the market and kind of what you're seeing on the market. And obviously, Old Capital does a lot of lending, so we kind of see it from the banker's view, and obviously I feel it from the ownership view. But you guys are in the trenches day to day, slugging it out unit by unit. So what's kind of maybe talk about this kind of the general market, maybe 2016, how that kind of has compared to the previous years, and what have you seen? We're sitting here towards the middle of February 2017 as we record this podcast. So what are you kind of seeing today on the ground as well? So maybe just kind of I'll turn it over to you and let you just kind of talk a little bit about the market.
Yeah, so for the last couple of years, they've been calling for rent growth moderation within DFW, and we did not see that in 2016. We didn't see it in 2015 either. And so far in 2017, we're seeing the rents continuing to tick up. So I think overall, when we're talking about the DFW Metroplex, we've seen such tremendous job growth, which is employment growth. And it's been so diversified. Before, Dallas was always considered just a financial services, real estate kind of city with maybe a little bit of energy and that kind of stuff. Now we have auto manufacturers moving here. We got a lot of banks and insurance companies moving here, moving their regional headquarters or their national headquarters here. They've created a lot of new jobs and a lot of diversification in that employment base. So still very bullish overall on DFW compared to a lot of the different markets out there in the country. There's a couple markets where, honestly, I don't understand the growth as much, but I won't throw any.
Give one out. What market don't you understand right now?
I think a lot of people obviously are moving to like the Colorado markets, right? But I still don't really understand the metrics in which they're trading under. You're talking about sub-3 caps in some cases, right? You've got 80s vintage properties that are trading well over 200-300 a unit. They were trading for 40-50 a unit a couple of years ago, right?
Yeah.
I mean, such tremendous growth. DFW has had tremendous growth, right? They've had a tremendous amount of new employment growth, and so is maybe like a Denver, right? Mm-hmm. But not comparably. I mean, the employment growth is nowhere close, right? And it ultimately breaks down to just that. It's somewhat that simple, right? How many people are moving there and have jobs? Because those are your rent payers, right? And those are the people that are going to stay. The people that just kind of want to live there because they want the lifestyle and the culture and that kind of stuff, they'll ultimately dissipate when the market kind of tanks a little bit, right? Because they need to make money.
Right? Yeah. Yeah. So 2016, 2015, the rent growth did slow down. I mean, what do you kind of see? You primarily focus on B product and suburban DFW near, kind of the generally the better parts of town, right? And that's kind of just basically what they do. So what kind of, in that specific segment, what kind of pricing or rental rate growth did you guys kind of see over the last, say, 2 years?
Yeah, I think for us, and we're talking about kind of not rent growth from going from upgraded unit to an upgraded unit, you kind of have to discount that out. But, somewhere in that 3.5% rent growth range, maybe 2.5% to 3.5%, depending on the location in the area. I mean, I think ultimately, if I were looking at buying right on my own accounts, I would say look in areas where the location is key. Clearly, drive patterns, right? A lot of good drive-by traffic. A lot of people, they don't think that I think if you were just like me a couple of years ago, if you were just looking at a property along the freeway, right? Say, I don't think I want to own that because it's got to be loud for those tenants, right? But some of the best deals I've seen are along freeways because they get visibility by a lot of people, right? It gets back to, kind of more traditional marketing, not the non-traditional marketing. So I'd look there along with communities that have great school districts, right? Because everybody wants to put their kids. There's one thing that's consistent amongst most people is that they want their kids to grow up with things that they didn't have, and they want a better life for their kids. So they're always going to push towards the better school districts and the better areas of town. So to have those kind of tangible items in an asset purchase will help you in your risk mitigants, right, as you move into this next cycle.
Well, people say that they could talk with you for another hour or two. I certainly would be one of those people. Craig and Todd are just a wealth of information on the property management side. I can see why Mike uses them and has used them for a number of years. Craig kind of knows exactly what's going on, and Mike trusts Craig. And that's, I think, the partnership or the relationship that an ownership group must have. You must trust your property management company. You know, interest rates can change in a heartbeat. We could have an interest rate of X and then it becomes Y and the market may slow down, but you have to have operational efficiency in your buildings. So if the market starts to slow down, you've got to get the best property management company out there to manage your asset so you don't have any problems. James, anything more you want to add?
Is there anything else that you would want new owners, especially maybe new clients that you guys are looking to bring on? Anything specifically they would, want in terms of reaching out to you guys? What's the best way for them to connect and just sort of at least start the conversation, whether they have questions about you guys or properties that they're looking at acquiring or moving over to you guys?
Yeah, absolutely. We'd love you just give us a call here. So we'll give you a couple of different numbers and email. So my email is tparks@simcmanagement.com. And then our office number is 214-522-1310.
Todd, you're probably the best person for people to reach out to. So yeah, definitely reach out to Todd if you guys have any questions on a potential deal you own or maybe you're looking at buying for sure.
What else is going on in the Old Capitol biosphere?
In the next couple months, we have two big events. On Wednesday, March 8th at the Grapevine Convention Center at 6:30, we'll have Greg Willett come in and speak about the apartment market. He's the economist for RealPage, I believe, who they see almost every lease that gets signed in DFW. So he'll provide, up-to-minute data on that. And then also Wednesday, April 26th at 6:30, we'll have Mark Dotzauer with the Texas A&M Real Estate Center come in and speak as well.
Those are great people to listen to. I can't recommend those two people highly enough. And that also, too, is a great opportunity to do some networking. So I think those start at about 6:30 or so, and the speaker comes on at 7:30 or 7 o'clock. But what a great place to find like-minded people that think of real estate is a solution to their retirement or investment. And you could shake a lot of good hands with people that are similar and like-minded like yourself. And then, James, what do you think about a rating?
A rating, yes. If you, on iTunes or Stitcher, if you go on there and give us a rating and leave some comments, that'll give us an opportunity to provide, feedback to us, but then also allow us to grow our audience and have more great speakers like Craig and Todd today.
Well, we'd like to thank Craig Lashley and Todd Parks with SIMC. You guys have been wonderful. Thanks for sharing all the information.
Thanks, Paul.
The insider information.
Appreciate you having us on today.
Always like that. Michael Becker, always a pleasure. Thank you, sir. James Zhang, thanks for hanging out. I'm Paul Peebles. Thanks for listening.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.